Good afternoon, everyone. On behalf of 4S Services, I welcome all the participants to the Apar Industries Q1 FY20 earnings conference call. Today on the conference we have Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and Mr. V.C. Divakar, CFO, Apar Industries. I would now like to hand over the call to Mr. Kushal Desai for his opening remarks.
Thank you. Good afternoon, everyone, and a warm welcome to the Q1 FY20 earnings call of Apar Industries. I will start off with some industry highlights, follow that up with some more specific financials and segmental performance details, and then we can open the floor for questions. At the outset, Apar had a relatively good quarter to start the year, with profitable growth across all our three businesses, the conductor business, the specialty oil business, and the cables business. However, the conditions remain reasonably challenging in this environment, which has some tepid demand and a fairly high level of credit tightness. I will cover a few of the highlights in the T&D sector as such. So T&D orders of over 13,500 crores were announced by key companies in Q1 FY20. There has otherwise been generally a reduced order inflow that has been witnessed by most of the companies. Just very recently, 6 BOOT projects have been awarded, 2 to Power Grid, 2 to Sterlite Grid, and 2 to Adani. And hopefully that should start a series of new transmission line orders. 2,110 kilometers of AC transmission lines and 12,450 MV of AC substation transformer capacity was added in the first quarter of FY20. Power Grid has an FY20 capex target of about 15,000 crores, out of which 2,909 crores were done in Q1 FY20. This is lower than the average for the past few years, which has been 25,000 plus crores. Hopefully, as the year passes by, there will be some additions that take place to this target. In terms of the budget of FY20, we saw increased allocations to some key distribution schemes compared to FY19 revised estimates, such as 5,280 crores to the IPDS, which is the Integrated Power Development Scheme, which is 33% more than in FY19. 4,066 crores to the Deen Dayal Upadhyay Gram Vidyut Yojana, which is up 7% over the previous year, and 1,035 crores to the Power System Upgradation and Development Fund, which is 90% more than the previous year. However, the total allocations to the power sector in the central schemes amounts to only 11,969 crores compared to almost 14,000 crores in FY19 and lower than what was in the previous years prior to that. So this just shows a nominal increase of a couple percent even to the renewable energy sector. So still a lot of the growth which is to come is still to be announced as such. The government is still working on Reform 2.0 to solve the endemic issues that are plaguing the DISCOMs, which are still suffering from losses higher than what is planned. We expect some announcements to come soon, but these unfortunately haven't been announced yet. Proposals include the Power Sector Council to resolve center and state issues, setting up of a pan-India power distributor and building renewable energy management centers across India. The CEA's draft plan for the power distribution sector emphasizes 100% smart metering and an increase in distribution substation capacity by 38% and distribution transformation capacity by 32% till 2022. However, no specific announcements have been made yet, which is what is a little worrisome for the industry. Arrears in payment from central and state governments for billing which has been done as early as March 2019 still remains to be cleared, which is causing a credit jam throughout the industry. there seems to be no clear visibility in sight for the situation to improve. In terms of the railway electrification, this continues to be a major driver as electrification products are being planned by the government to electrify the balance 28,800 railway kilometers to broad gauge by FY22. In addition to this, there are also multiple expansions going on and execution happening on the metro rail side. So based on this overall background, I would like to now just cover more specifically Apar's financial performance. In Q1 FY20, consolidated revenue came in at 1,984 crores, which is up 32% year-on-year. EBITDA post Forex adjustment came in at 137 crores, which is up 22% year-on-year, with a 30% increase in conductor division EBITDA, 42% increase in the oil division EBITDA, and 72% increase in the cable division EBITDA. Profit after tax came in at 41%, which is up 42% over the same period previous year. Looking at the segmental performance, our conductor business grew 61% year-on-year to reach 1,022 crores in the first quarter. Volumes increased 29% to reach 41,802 metric tons. The EBITDA per metric ton post Forex adjustment came in at 12,137 compared to 12,073 in the first quarter of FY19. The share of higher value business, which is primarily from the railways and the high efficiency conductors, came in at 40%. 27% of this came from copper conductors and 13% from the high efficiency conductors. The order book at the end of June 2019 came in at 2,656 crores, which is up 9% over the previous year. However, this is lower than the year opening order book which we had, which was 3,020 crores, and is basically reflective of a slower pace of orders being awarded. Initially, just leading up to the elections, the model code of conduct was preventing finalization of tenders, and post the budget coming up, we've really not seen the kind of pace of activity that one should be seeing. This includes about 373 crores from the railways for copper conductors and 473 crores of high efficiency conductors. The new order intake came in at 594 crores, which is well below what we had seen in the first quarter of last year, for some of the reasons that I just mentioned earlier. Our CTC project for the transformer industry, supply of the copper transposed conductors in transformer manufacturing, that has now been commissioned and trial production has begun. Coming to the specialty oil segment, the revenue increased to 619 crores, which is 8% higher than the previous year. Volumes were at 1,06,000 kiloliters, which is up 13% over the same period previous year. The Hamria UAE plant's capacity utilization has increased to 70% from 56% in the first quarter of FY19. This is reasonably commendable given that the Middle East region is still under considerably stressful economic conditions. The auto lubes and the industrial oil business contributed to 23% of the revenues. Demand from OEMs and general industrial customers remained quite muted through the quarter, and it seems a little bit more difficult in the second quarter of this year. We don't see any visible changes that are likely to happen in this environment in the absence of anything that's announced by the government to spur growth and the investment cycle as such. The EBITDA per KL for Forex after forex adjustment improved by 26% and came in at 3,907 rupees per KL. Coming to the cable business, so the cable business had its best quarter so far and delivered a revenue growth of about 24% year on year. So this is at 394 crores. This was driven by a 62% growth in the elastomeric and E-beam cables, with good demand coming in for supply of railway cables, railway harnesses, as well as the defense segment. Power cable revenue was up 20% year on year in a highly competitive market. Telecom cable performance was flat compared to the same period previous quarter, but we expect it to be substantially lower due to the financial challenges which exist at particularly BSNL and the condition of most of the telecom companies, where the capex cycle has really been frozen, including at Reliance Jio. EBITDA margin post forex adjustment came in at 13.2% versus 9.5% in the same period previous year. The demand from non-conventional energy power plants is expected to be strong in the future. However, we see a temporary slowdown in that segment, including power cables and telecom cables, which are the worst affected as such. And even the elastomeric cables, the current order book remains reasonably strong for Q2 and a part of Q3, but we await new tenders to come in to keep the continuity of flow of orders at the current pace. So in conclusion, I would like to summarize that we had a relatively good Q1. The visibility for the rest of the year remains a little bit clouded at this stage, especially in the absence of more specifics in terms of schemes or demand generation incentives in the near term. The government, through its annual budget, has painted a very aggressive longer term growth targets and numbers, but the shorter term, as I said, is a little bit unclear. Demand across all segments is weaker than we would like, and the credit environment continues to be more challenging than one would expect. Our strategy as a company is to operate relatively conservatively in this environment with a close eye on both the cash flow and the balance sheet. We are hopeful that the demand environment should improve, and as this takes place, we are obviously ready to encash on all the opportunities that come by. So with this, I come to the end of my comments as such. I would like to thank everyone for joining our call and now open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder, you may press star and 1 to ask a question. The first question is from the line of Maulik Patel from Equirus Securities Private Limited. Please go ahead.
Thanks for the opportunity. A few questions. You mentioned that there is a significant credit crunch in the systems, and particularly the government, the customers are not paying. How long this situation has been? And as you mentioned that you don't see any near-term solution to that. So worst, what could it get? Because what you understand that there's a cascading effect across the value chain, not only in the sector which Apar operate, but there are other sectors which where the government or the PSUs are the large customer.
Yeah. So, Maulik, we are seeing that payments started slowing down, post February 2019, and the industry's initial feeling was that it's maybe, as the elections are approaching, etc. But post the elections having got completed, we are still seeing payments from some of the utilities, mostly state-related utilities, which haven't yet come in, from March of 2019 onwards. This, as a consequence, is resulting in a lot of credit jam in the industry as such. So you find, for example, transformer manufacturers not wanting to manufacture fresh transformers, even though they may have certain orders in place, in the absence of receiving previous payments coming in from the utilities. And so this is resulting, actually, as the time is passing by, a more difficult situation in terms of even demand coming from that segment. We've also seen even the highway projects which were running at a very rapid pace, they have also slowed down to some extent. So that has had an effect on some of the industrial lubricants and some automotive lubricants which actually go to these operators. Finally, on the fiber optic side, you have BSNL, which seems to be also in very serious financial trouble. So even previous orders that have been supplied by the industry, the balance 10% payments haven't been received for more than a year. So some of these, of course, Apar is relatively not the largest player in that segment. There are some very large players in this fiber optic side who probably have been affected much more than us. So when you add all this up, it means that, some of these areas where in 2019 the demand was very strong, the cycle has got a little bit hurt. On the other hand, we are finding that as far as the railways is concerned, the work is still going on at a reasonably rapid pace. In fact, the supplies have outstripped the speed with which some of the EPC contractors have been able to string, and complete their projects. But otherwise, the demand continues to remain strong. So both the copper conductor side as well as the cables which supply, railway cables, railway harnesses, etc., seem to be reasonably on track. The government spending on the defense side continues to remain good. But it's the power side where, we are seeing the slowdown and problem at the moment, largely coming from, payments that should be coming through.
Got it. And specifically in the conductor, I think that order inflow which was expected to improve significantly post the election, has that happened?
So the silver lining is that, as I mentioned in the call, very recently 6 BOOT tenders have been awarded. 2 have gone to Adani, 2 have gone to Power Grid, and 2 have gone to Sterlite Grid. Sure. This entails conductors of approximately 100,000 metric tons.
Okay.
So they will then come out now in the next few months, for bidding. So that is like the beginning of, and plus, as I mentioned, some new awards have taken place for substations. But this is, seems like the beginning. It needs to be at a much more rapid pace if the government is to execute what they have planned. And so hopefully in the next few months, the pace of this activity should pick up. On the other hand, we have seen some finalization of the high efficiency conductor tenders. We had been in our previous call saying that some of these were stuck because of the model code of conduct, even though the tenders had opened. So we have started receiving some of those. We received about 103 crores in the first quarter. And we expect a larger amount of it to come in the second quarter. So things are starting to show some signs of picking up, but the pace of this is still not something that we can calibrate yet.
But there is also in this all this uncertainty from the government in terms of payment and that, and probably there is in a longer cycles what the players like you have it. But will this translate into some kind of a margin, or it will improve the margin? If you can, probably, because there are certain smaller players who won't be able to sustain this liquidity crisis. Will they make an exit, and then subsequently there is a better competitive position for you?
So actually, to tell you honestly, things are a little bit unclear right now. So we are just hoping that in the next month or so, if there's more clarity that prevails, then when we have the next call, we should be in a better position to be able to gauge, the environment as well as the competitive scenario. All I can say is that as the high efficiency conductor demand comes up, then you will see a weighted average improvement, taking place on the conductor side. compared to what we were expecting or what we had in the previous financial year. And if the pace of activity with the railways and defense continues through the year, then our cable business, which has delivered 13.5% EBITDA,
Sure.
we see numbers which are better than what we had seen last year, which is closer to 11%. But otherwise, to get into more specifics, when things are so, it's not very clear right now, I think it would not really be correct on our part to, make a more definitive sort of statement.
One question, the last question is on the utilization side. In cable, the growth has been fantastic over the last many years, and the efforts which have been put for this the E-beam conductors and E-beam cables and others has delivered. Now it is 1,800, 1,700 kind of an annual revenue. Do we need to put more capacities, and is there a significant large capex to be planned for the cable to take a next drive of growth?
So we have planned in this financial year a total capex of about 160 crores across the the three divisions. So that's something which has already been in the plan. The cable business, we see a total of about 70 crores of investment going in, which includes putting in a new electron beam, because the two existing ones, the good news is are running pretty much at full capacity.
Okay.
So there is a capex program which has already been planned, but going into FY21 and FY22, you will see a significant slowdown in capex required across all the three businesses. Then you pretty much end up putting just some balancing equipment and things to take us through with a 20% growth, 20-25% growth over the next couple of years.
And in conductor, the first quarter growth has been very strong at around 29%, 28% kind of the volume growth. So will this, is this can we expect a high growth throughout the year, or this will definitely moderate in the coming quarters?
So we see it's quite likely that it will moderate in the second quarter for sure. And then, it all depends on, all these awards, getting their funding closed and the ordering, starting to take place.
So what would be the good number for the full year to estimate in terms of a volume?
So we are targeting, as I said, our target has not changed as such. We are still targeting a volume of about 190,000. But, depending on finally what happens with Q2, it may close at maybe 180 or something. But, don't hold us to the number yet, because the visibility is still a little bit weak in terms of, the speed of execution that will happen.
So in case of 190, we are looking at around 4% growth, and 180, we are looking at a flattish number.
Yeah, that is on a per ton basis. But as I said, we are very optimistic that this year our high efficiency conductor volume as well as our copper conductor volume will both be up. We are still looking at about 18,000 metric tons for copper conductors and 15% plus revenue to come from our high efficiency conductors.
So the mix is better.
Sorry to interrupt you, Mr. Patel. Hello?
Sure.
Yeah. Please come back in the question queue for a follow-up question.
Sure.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Pratiksha S. from Equitas Investment Consultancy. Please go ahead.
Thank you for the opportunity. So this question is relating to the interest cost. So just for the Q1, I realized that the interest cost is about 2.89%. So what essentially it shows me is that, our finance cost or the outgo for the debt stakeholders is higher than what our PAT margins. And I mean, I know it's just a way of looking at these numbers. And also, if I compare these numbers by, with, say, 2 years back, our profit numbers are in line with what we did average quarterly in FY18 or some second half of FY17. But with a significant revenue growth that we've seen over the years, FY19 we did about 33% revenue growth. nothing is translating down to the profitability. So just wanted to have your comments on that. Secondly, data point, if you could just share the LC borrowings, for this quarter as on June. And then I'll have another question later.
The long-term borrowing is about 159 crores and the short-term is about 150 crores. So that is about 308 crores or something like that. And apart from that, we have the suppliers credit actually with interest actually. So in that, the LIBOR-based credit is about 1100 crores and the domestic credit with domestic interest is about 1000 crores. As you have seen actually that the interest cost has gone up actually, that we have said in last 2-3 calls we have been saying actually, because we have a lot of LIBOR-based borrowings actually, and the LIBOR rate which used to be about 1.8 or so had gone up to about 3.25, something like that actually. So there was a substantial increase in the interest rate. That is why the interest cost has gone up. If you see, as far as this quarter is concerned, there is a business revenue has gone up by about 32%.
Right.
Compared to Q1 of FY19.
Right.
That main revenue is on account of the railway conductors actually. In conductor division, the revenue has gone up by 61%.
Right.
So that is mainly driven by the railway conductors actually, which are fully domestic and which are to be financed through domestic borrowings only.
Right, but having said that, are we contemplating any change of strategy in managing our working capital or reducing our suppliers' credit? Because the interest outgo is essentially increasing every quarter, and then the revenue growth is not translating to profit growth. My concern is coming from the fact that today 2.89% of our revenue is our interest outgo, and that I think is significantly contributed by the suppliers' credit.
So, there is no change really in the number of days, that one is managing. If you look at the number of outstanding days and, net working capital, it has increased to some extent, but it's not increased very substantially. So I won't look at it from that perspective because each business, requires funding of its own type. If you have suppliers credit coming in from overseas, the net interest rate is lower than if you're funding it in Indian rupees. So the way we fund it is we try to fund it such that we end up hedging, the currencies, and we borrow money as far as possible in the same currency, or we need to take forward cover hedges. Going forward, I would see that if the interest rate regime becomes a little bit more benign, then you would see some amount, coming off from that.
But
in today's, what this covers is just not interest. It also ends up covering bank charges.
Which would be for your LIBOR-based, these suppliers' credit borrowing, right?
So that is one part, but a lot of customers today are also paying on letters of credit. And in the current credit environment, we would rather pay LC opening charges and discounting charges and things like that and make sure that our credit is secure, as opposed to, have open terms or terms which are relatively more open-ended with customers. So what you see here is not only credit that comes from purchase, but it also includes credit that's going out on sale.
Which will be a very environment, right?
I don't see any change happening in this regard because it's just a very difficult credit environment at this stage.
Right, but see, when you say that your working capital days are in control, or the working capital days are that high, that's because your receivable days are low as you're discounting your sales, right? You're discounting your debtors, which is coming at a cost, and that's reflecting into, that's impacting my profitability.
But when we give number of days, actually, we give the full cycle, actually. We take the discounting also, which is on our account.
Just to close this chapter, in today's credit environment, it makes sense for us to pay the extra cost for securing our receivables. And that is what is being reflected over here. I don't see that scenario changing in the next, at least for the remaining part of this year. So it's just it's a management call in terms of whether you want to increase, interest and bank charges to make sure that credit delivery is a bit better under control.
Okay. And okay, my next question is regarding the oil segment. We had some high cost inventory that was impacting our margin for last couple of quarters. So are we sorted on the high cost inventory, and now can we expect consistent margin improvement? How much do you anticipate the margins to improve on this front?
So if you look at the margin portfolio that we have across products, we end up delivering higher margins on our automotive and industrial relative to next comes transformer oil, and then finally process oils and white oils. So it's a little tricky to say how margins are going to improve over the next few quarters, because the automotive and industrial side is a little bit more under question. Even transformer oil demand has been affected, as I mentioned earlier in the call and while answering the previous question, that due to lack of payments, the movement of transformers has been relatively slow. So in this whole oil portfolio, we are a little bit, it's not very clear in terms of, how the margins would stack up in the absence of how demand itself would stack up.
So would you be able to give any, like you've mentioned that, the volumes might be impacted, the demand is impacted going forward. Would you be able to give any, what quantum or any specific detail around it?
Not really, ma'am, because the orders are there with people, but, depending on the cash flow coming in, the execution will then take place. So that is something which, it's difficult to lay a finger on. In terms of the automotive side, it's been a little affected across the board. So you have first fill business going down because production of all categories of automobiles have come down. The retail side has held up relatively well for us, but therefore the overall volume is lower on the automotive side. On the industrial side, it's a straight function of the amount of industrial activity that's going on, and definitely that activity is affected right now. So the more you run the machines, the more lubrication that goes in, and it's clear that the machines aren't running as much as they were. So it's very difficult to tell exactly what the volume will look like, but maybe at the end of another quarter, there'll be more visibility in terms of how this will pick up.
Okay, and if I can squeeze just one question on cable front, if you could just give some light on the hierarchy of margins, like what kind of cables have the margins, like just you mentioned about the oil, similar way.
So you have the elastomeric cables, which basically go to railways and defense. They are at the top of the stack. Then you have cables that go into solar installations and things which come next. And then following that is really fiber optic, and then finally power cables.
Okay, thank you.
Yeah.
Thank you. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Anuj Upadhyay from Emkay Global Financial Service. Please go ahead.
Thanks for the opportunity, sir, and congratulations on a good set of numbers.
Thank you.
So my question pertains to the margin across the conductor segment. Based on the calculation, the realization has gone up by almost 20 to 24% this quarter. And even we have around 40% of our execution being towards the high profitable conductors, that is the copper conductor and the HEC. In spite of that, the number is not reflected on EBITDA per metric ton basis. Even on an adjusted basis, it's flat on a year-on-year basis. Could you just explain the reason behind that? Even in the margin front, if we say it's down by around 100 bips.
EBITDA is about 12,000 rupees actually. If you see our whole year's EBITDA last year, it was about 9,000 rupees. Only in this quarter actually the EBITDA was about 12,000. Later on for the whole year, if you see, the EBITDA was 9,000. So the EBITDA has improved really actually.
Not on Q on Q, sir. On a year-on-year basis.
Actually, was high in the first quarter.
So do we have a high base in Q1 FY19 as well?
So
yes.
in Q1 FY19, we had a relatively higher EBITDA relative to the remaining 3 quarters.
Right, sir.
Because that's where we had a good percentage of execution of these high efficiency conductors.
Plus even the
subsequent to that, it's actually tapered down. This year, we are expecting that with the current order books which are there, as well as what awards are expected in the pipeline, the high efficiency conductor side should be better than in the previous year. So that's reflected in the first quarter, and hopefully if this continues through the year, you will see a better EBITDA, coming in, a proportion coming in from the high efficiency conductor. But as Mr. Devadkar says, the average for last year was about 9,000.
Right, sir.
Versus this first quarter, which is at 12,137.
Okay, so can we expect not 12,000, but at least a better margin compared to what we had in the last year?
Yes.
I think it should be the case. As I said, some of these new, even boot projects and all which have been awarded, the financial closures need to take place on these, which will then dictate the pace at which the ordering will happen. Okay. So there are a few, the environment is a little tricky, as all of us know. So it all depends on the orders are now in place, and we are expecting more high efficiency conductor orders to come through the year. But the execution then gets a little bit more dependent on the finances which are being allocated, for execution of these projects.
Okay. And this order book of 2656 crore is to be executable over what period of time?
About 8 months.
About 8 months. Fine, sir. That's it.
Yeah.
Thank you.
Thanks.
Thank you. A reminder to all the participants, you may press star and 1 to ask the question. The next question is from the line of Dhiral Shah from Phillip Capital Private Limited. Please go ahead.
Yeah, good afternoon, sir, and thanks for the opportunity. Congratulations for the good set of numbers. So my question is regarding, so what kind of revenue guidance you give for FY20?
So honestly, it's a little tricky for us to give the guidance, as we've been saying through the call, because we don't know the pace at which execution will take place. At this stage. So we've Q2 has been relatively soft, so far, at least for the month of July, and we don't see any major pace of activity picking up, in the month of August, at least in the absence of any major triggers. There are some segments or some pockets which, as I mentioned earlier in the call, which is railways, defense, that seem to be still moving at a fast clip. So it's difficult for us to give an exact revenue guidance at this stage. Maybe by at the end of the second quarter, when we have the call, things will be a bit clearer.
But maybe double digit kind of is it can be doable?
We have prepared ourselves for double digit growth across all the businesses, but it's really a function of execution right now.
Okay. And sir, in terms of margins, at least 7 to maybe 6 to 7%, is it sustainable?
In terms of the EBITDA margin?
Yes.
Around that number, correct?
Is it
possible? Yes.
Yeah, it is sustainable. The only caveat would be that if demand really starts falling off, in which case the allocations don't really happen for utilities to utilities, then the total execution itself will then come down. The total sales will come down. So as a consequence, then it will have an effect on the EBITDA. Our sense is that the government will have to come up with more specifics. They've been talking long term, but they have to come up with more specifics for the short term to kickstart this slack that happened just pre-election.
Okay.
So as soon as that kicks in, then I would imagine that the flow of business will start increasing, and we will get better visibility to give guidance.
Okay. And so this after this 170 crore of capex, you don't think FY21 maybe FY22 you require any further capex?
We don't see our conductor business and the oil business, specialty oil business. Actually, the capex will fall off very substantially. Our oil business, we would have completely gone through with expanding, in all the product lines, including our automotive and industrial side. So the capex will be very limited there. And even on the conductor side, we have come to the end of, the major capex cycles. So it's really just the cable business to focus on, the cabling side, So So the e-beam capacity is going in this year, etc., etc. So we see capex falling off quite substantially in FY21.
Okay, so then focus would be on debt reduction, right?
Yeah, we don't have a lot of long-term debt. It would really be, the focus would be more on then extracting, asset turnover from the capex and asset base that we have.
Okay, and so what is the current capacity utilization right now across the plant?
So it varies across product lines, but if you take a weighted average in the cable business, it's close to about 90%. We have capacity that's available on the on the optical fiber side. The elastomeric cable is running at 90% capacity, and the power cable business is running at around say 75 to 80% capacity utilization right now. The oil business has plenty of capacity available. 70% in the plant in UAE, and here we are somewhere in the 60% range in terms of capacity utilization. Conductor plant first quarter has run pretty much flat out, but in the remaining 3 quarters we are focusing actually on a change in the mix to happen as more high efficiency conductors and as the copper conductor also continues to increase.
Okay. And sir, let's say next 2 to 3 years, can we expect our revenue or top line to touch around 10,000 crore?
It's difficult to predict that, but I can only say that capex will fall off and asset extraction will improve. So that should hopefully enable more free cash flow in the business.
Okay, along with margins to be around 6 to 7%, or it may also improve with utilization going up.
So we are focusing on high efficiency conductors and all these other copper and things like that, which provide a better profit per metric ton basis. Similarly, on the cable side also continuously we've been improving margins based on the mix that we have. On our oil side, as our automotive and industrial business grows, right now it's hit a really rough patch. But I'm sure that it will also climb out of it. So as that happens, then the margins even on the oil side especially oil side, will further expand. So our sense is that in the future we should see better profitability across all the 3 product lines.
And sir, last one, if I may. Sir, out of the 3 business, which is the highest margin business? Let's say from cable, conductor or oil?
So at the moment the cable business is delivering the best profitability across the 3. As you can see, the EBITDA is also at about 13.5% for the quarter.
Okay.
Our target was to do 11% for the year, which is up from 10.5 of the previous year. But if things continue like this, then hopefully we'll beat that number.
Okay.
All right. Thank you.
Yeah. Thank you, sir.
Thank you. The next question is from the line of Pratiksha S. from Equirus Investment Consultancy. Please go ahead.
Just a follow-up question on conductors. So what are the ramp-up plans for CTC conductors that we have for FY20 and maybe FY21 if you have any visibility there? And secondly, we were envisaging some 1,000 rupee per ton cost savings after the Hindalco agreement. So how much of that is already reflecting in our margins, or do we expect some amount of, because there were some grid issues and, connectivity issues in Jharsuguda. So do we expect any more cost saving benefits to, reflect Q2, Q3 onwards?
Yeah. Chaitanya, you want to take that?
Yeah. So as far as the CTC ramp up, this would be the year where we are getting, approvals from various utilities and also their clients. So we hope to get about 2,000 metric ton business this year. And next year will be more like 4,500 or so. And then the following year we hope to reach our full capacity utilization of about 7,000 tons. Plus we are adding on some, balancing equipment for PICC. So that will also help in, utilizing our capacity better. On the Jharsuguda side, we have been getting this benefit. In fact, the benefit has gone a little bit more because of the furnace oil prices having increased. So that realization is happening. we also now have the grid power. So on the operational side, the savings have all been accrued and will continue.
Okay. Thank you.
Yeah.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Levin Shah from ValueQuest Investment Advisors. Please go ahead.
Hello.
Yes, please go ahead.
Yeah, hi sir. So my question is on this cables division. So whatever improvement in the margins we have seen, is that because of the mix change that has happened during the quarter, or it has also to do with the raw material benefit or any pricing decision that we might have taken?
So it's to do with mix as well as with the larger actual volume that we've produced of cables. So there's an economy of scale effect as well as the mix. As I mentioned earlier, we've seen a 62% growth, in the elastomeric and E-beam cables, and in terms of the profitability stack, that sits right at the top. So
right.
That is one of the main reasons for it. We expect it, to continue as far as railways and the defense is concerned. There is also a very ambitious plan that the government has and has announced a lot of solar projects as well as wind projects. But, given the current environment of what's happening in Andhra and, with scrapping of projects and things, I guess environment is a little bit, more difficult in terms of raising funding for some of the EPC players and, some of the guys developing these projects. But if that comes through, then even the solar side will be very strong. So we expect that, margins will, if the demand remains like the way it has been in the first quarter, then the margins will come in at, levels which are not very far from the first quarter.
Okay. So does that mean if we are able to grow like 20% plus for full year, we might see margins which are similar to this?
So 20% for the full year, and the elastomeric cable business also needs to, show strong growth.
Right.
Two out of the three legs are doing all right, which is the railways and the defense. It's really the non-conventional energy side, where if that does what is expected in the year, then we'll see good profitability on the cable business.
Right. And sir, how much of this elastomeric and E-beam cable would be contributing to the total segment sales?
So the total segment, Divakar, you want to just take it?
This is about 27%.
Okay. 27% by revenue.
Right.
The largest portion, of course, comes from the power cable side, which is around 60%. And the optical fiber is around 12%, approximately.
But in terms of margins, so this elastomeric and E-beam would be much higher as compared to the other two, right?
Yeah, it would be at least 1.5 times more than the power cable side.
Right. Sir, and one more question on more sort of longer time frame. So if we see from like 2-3 years perspective, how do you see this overall cable segment, and in that elastomeric, E-beam and power cable growing over next 2-3 years?
So we see actually the cable side of the business will continue to grow. In fact, the rationale that we had of buying into this cable business, the acquisition, was that the maximum amount of money and reforms need to come on the distribution side. And we continue to feel that over the next few years, that is where a lot of money will still have to be spent, because the last mile is still the weakest link that we have even today. So the government has come up with various schemes. Some of them have worked, some things haven't worked. They'll have to keep on working on it until you find the right solution. So we see that the cable side, the demand should continue to remain. Now, competition may also heat up, but the demand will remain there for cables for the next 2 years.
Right. And for this elastomeric and E-beam, over here the main driver would be the railways and defense, right?
Railways, defense, and solar. Non-conventional energy. There's a lot of elastomeric cables that go into a windmill.
Right.
In the windmill itself. And then all the solar paneling requires elastomeric cables.
Mm-hmm. Right.
So as a non-conventional energy goes up, you'll require cables. In fact, one of the biggest growth drivers for the cable, for the specialty oil business and the conductor business is really the green corridors which will come up, as more and more of these non-conventional energy projects get executed. Because each one of them needs a unique evacuation into a grid.
Right.
They are all spread out. Unlike a thermal plant, which is, or a nuclear power plant or a hydroelectric plant, which is very concentrated in terms of where it generates power, any of these non-conventional energy plants are spread out, quite geographically spread out. So each one of them requires a link to come into the grid. So, as this proliferates around the world, it's not just an India phenomena. Around the world, we see that all these three businesses have, demand will be there over the next few years.
Right. Correct. Okay, sir, that was helpful. Thank you and all the best.
Yeah, thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask the question. As there are no further questions, I will now hand the conference to the management for closing comments.
Thank you very much for all of you to be on this call, and we hope that there'll be more visibility in the next couple of months. So when we have our second quarter earnings call, hopefully we should have better visibility in terms of the second half as well as for FY21. So thank you all for your time and goodbye.
Thank you very much.